The British economy doesn't have its problems to seek. One of them is the relative strength of sterling. Earlier, I asked Bank of England policymaker Paul Fisher in the building behind me just how damaging that has been for UK PLC.
Well, it's been very awkward because the strength of sterling has come about not so much because of a sterling-specific factor, but the weakness in the euro. And of course we export a lot to the euro. We actually want the euro economy to grow strongly as well. So it's very difficult to try and determine what you really want the exchange rate against the euro to be. I think more generally we've been disappointed with the degree of rebalancing of the UK economy. The exchange rate is only one part of that, and I think a depreciation of the exchange rate like we had in 2007-8 really works best when the rest of the world is growing, because then we can increase our market share in a growing market. It's much harder to grow your market share in a shrinking market, which is what the business has been trying to do over the last year or two. And so I suspect that the exchange rate is important. You can make a good case for it being lower, would be a more appropriate rate. But I really think the key to this is quantities. And the fact that Europe in particular is not growing is really the constraint for us.
So, but just to clarify that point, I mean, ceteris paribus, in an ideal world, you and the bank would prefer a lower exchange rate?
I wouldn't go as far as saying I prefer any particular level of the exchange rate.
Not any particular level, but just a lower rate in general.
What we have to say is it was appropriate that the exchange rate went down because we were in a terrible position in terms of current account deficit, and a lower real exchange rate is what you need to try as one of the components of trying to offset that. It's quite difficult to know exactly where the real exchange rate should be, and I think it's probably not been helpful that the exchange rate has appreciated over the last year or so. And so you have to draw your own conclusions from that.
Funding for lending scheme has been broadly welcomed in the press and in economic and market circles, but in reality, isn't it the case that it fails to address the fundamental problem for the UK economy, which, as we've just discussed, and that's a lack of demand?
Yeah, the funding for lending scheme is intended to remove a constraint from the supply of credit. The impaired banking system has been widely recognised as not being able to deliver the supply of credit to businesses in particular that the country needs. What we've tried to do is remove that constraint. And to the extent that we can encourage the banks to lend more, that may itself encourage a bit more demand but from businesses by having more confidence in their banks. But we'll have to wait and see. I think the funding for lending scheme has delivered already a big cut in interest rates. First of all, bank funding costs are down across the board, and that's very important. That will take quite some time to feed through. We've seen lower lending rates across the board for a range of things, from mortgages through to small business lending. So we've already had the monetary policy impulse, which is reducing interest rates. What we don't know is how the demand for credit will respond to that. Our fear was that the stock of lending would be going down. That's what we said at the start of the scheme. So any return to positive growth in lending would be a good outcome.
So how will we know, and when do you think we will know if the scheme has been a success?
I think it will take probably another 6 months or so. The numbers we released for end of September were 2 months after the launch of the scheme, and most of the banks had not been signed up for more than a month. So those numbers probably don't reflect the funding for lending scheme at all. What you can see in those numbers is the risks we were facing, which is some banks having to contract their lending while others were able to expand. That explains why we designed the scheme the way we did, to try and give an incentive to both those groups to lend more. The end of December data, when we release that, will be the first few months of the scheme in operation. That may show the first slight improvements in quantities, but I expect it will be the data after that which will really start to show the full impact of the scheme in terms of quantities. I think we're already seeing the price impact, and there's probably more to come from that.
Okay, just to finish up, I mean, this recovery, this UK recovery, has been the weakest in about 100 years, certainly according to some analysis from peak to trough. Does this suggest that Britain has suffered irreparable damage throughout this crisis?
I don't think so. If you really think hard about what fundamentally drives growth, like population growth, technology growth, the ability to combine all those in a dynamic economy, you can see some temporary reasons why growth might be slower, even persistently slower, but no reasons why the long-run growth rate should have suffered. Now, the longer you go on with high unemployment or low growth, the more some of those factors can get embedded, which is why we're all so keen to get growth back as quickly as we can. I don't think there's any real reason to think that fundamentally the UK is in a slow growth solution forever.